Schwab Asset Management has announced a 3-for-1 stock split for 20 of their ETFs, including the ever so popular SCHD, to make it cheaper for investors to purchase shares. Now, on paper, SCHD shares will look cheaper, but I'm going to share the truth about stock splits and how this may actually affect SCHD. Currently, SCHD trades at $84 per share, which means if the split were to happen today on 3-for-1, the share price would be closer to around $28 per share. SCHD is a blend of the higher yield dividend companies matching the Dow 100 dividend companies. The current dividend yield on SCHD is 3.5%. SCHD has a total of 103 positions, and the top 10 holdings alone make up 40% of the ETF. Now, here's actually a list of the top 25 holdings for SCHD. And as you can see, they're companies you know: Home Depot, Verizon, BlackRock, Cisco, Texas Instruments, all the way down here. This is their percent weight, from 4.3% all the way down to 1.14%. Now, it's very important to remember, dividends are a fun thing to get. I recently did a video about how I'm coming into some money from the sale of a company, and I plan on trying to live off this money the rest of my life. Now, since then, I've gotten so many messages on Instagram, on Twitter, and by the way, follow me on those if you want to interact, about people saying, finally, you see the point of dividend. No, I'm taking a portion of my net worth to live off of, to get a little bit of capital growth, to generate income through dividends and options to live off of. This is not my investment. Remember, guys, dividends feel wonderful and great, but dividends are one of 5 things that a company can do with its free cash flow. But you have to remember, dividends are highly tax inefficient. In order to pay a dividend, the company has to have cash flow. That cash flow is generated after they've already paid their corporate income taxes. Then you get the dividend, and you know what you do from there? You pay another tax on top of that. So whenever I hear people say, oh, it's unfair that dividends are going to rich people and they're only taxed at the lower capital gains rate. Yeah, but if they own the company, they are being taxed twice there. So it's really important to understand that although dividends are wonderful and great to feel, they don't actually make you richer. You're taking from a company that you own a piece of and putting it into your pocket, but you've also paid taxes on that. When the cash stays in the company, a lot of people have a hard time remembering and understanding this. When the cash stays in the company, you have an ownership stake in that cash. So theoretically, you're actually less wealthy because you've already paid that dividend. Now, of course, a lot of people would say, well, no, wait a second, Paul. I get that cash. It can never be taken away from me. I'll give you that. Of course, if the money sits in the company's accounts, they can go spend it on bad things or good things. The point is, a company should only pay a dividend, in my opinion, if it's the last resort for the company. Because remember, there are 5 things you can do with a company's cash flow: pay a dividend, buy back shares, invest in yourself, make acquisitions, or pay down debt. I do believe that dividends should be the last thing done with the company's money. Now, remember, a lot of brokerages have fractional shares of stocks and ETFs. So you might be wondering, why would Schwab do this split? Remember what a stock split actually does. It takes a piece of pie. If you have a piece of pie right here, cut into 4 pieces, this is the size of the pie. All a stock split does is, if it's a 2-for-1, makes it into 8 pieces. Has the size of the pie changed? Not at all. But people always think that makes the stock cheaper. It does not. It makes the price of the stock lower so you can buy more shares. But now, instead of buying, in SCHD's purpose, instead of buying 1 share, you're getting 3 shares. That's it. So everybody who owns SCHD right now, if you own 1 share of stock, you get an additional 2 more. If you own 10, you get 20 more. It's taking your ownership and 3xing it. That's it. The fundamentals behind the companies in the portfolio have not changed. They're still generating cash flow. They're still doing it on their own basis. All you're doing is allowing the stock and ETF to be able to be accessed so you can feel richer by owning more shares. That's it. It is not actually making you wealthier. It is not making the ETF or the stock better, especially with an ETF. None of these companies have changed. None of these companies did a stock split because of SCHD's stock split. None of this happened. Now, remember, going back to this, I love the fact that these ETFs, low expense ratio. This is actually lower than SPY. Great dividend yield. And this assumes that the stock stay at these current levels of pricing. So you look at this going, let's say the market pulls back quite a bit and a lot of these stocks fall 30%. This dividend yield is going to jump up. This could jump up close to 5%. That's a big dividend yield and it feels good. And I always tell people, if you're closer to retirement and you want some capital growth and you want some income, this is a great option. I'm not going to lie to you though, I do chuckle when I see people who are younger investing in SCHD. If you're young, you should want to invest in companies that can take their cash and keep compounding. High returns on invested capital is what you should want to get. So let's look at the history of SCHD relative to the performance of the S&P 500, because it's really, really important to understand that. Since SCHD started back in 2011, this is its performance versus the S&P 500. The S&P 500 total return, including dividends, has been 502%. SCHD, 407. This is a big difference, but I want everybody to keep in mind, the split started basically in 2023. Until then, it was pretty close, but as you can tell, SCHD was always trailing. And I think that's going to be the case for SCHD in the future. It is going to trail the S&P 500. Why? Because the companies that pay a lot of dividends tend to be very, very mature companies that can't really grow their earnings per share and their revenue at high rates. With the S&P 500, though, there'll be a lot of companies in there that aren't paying dividends, that are reinvesting their cash to generate more and more profit. So naturally, their profits should go faster, their revenue should go faster, and therefore the market cap of the company should grow faster. And you're seeing that here. Now, since this occurred, what's happened here? You've had NVIDIA, you've had all the Mag 7 absolutely pull away. So we really don't have a bear market really to look at here, but I will tell you this. This bear market here, SCHD did not do as bad as the S&P 500 during the COVID crash. So I do think it's a way to kind of even out some more returns. Don't get me wrong, this still went down a lot during COVID, but it wasn't as bad as the S&P 500. And my guess is when there is finally a bear market, the Mag 7 and all the high-flying stocks that drove the S&P values up will probably fall a lot bigger than the SCHD numbers. But again, if your goal is capital growth, which it should be, allow yourself to compound at higher rates of return without paying taxes. I don't know if SCHD is the right move for you. Now, everybody's position is totally different. And as you remember from our last video, I am putting a portion of my net worth in SCHD to live off of the rest of my life because I don't want to touch the cash in my real estate. I don't want to touch the cash that I generate from this YouTube channel. I want to reinvest it to get higher rates of return. I want to be able to take a portion of my net worth, have it sit there and do nothing with it except live off of it. That way, I can focus my business on reinvesting and building a bigger business. That's the big key there. I don't want to have my businesses pay me out dividends when I can reinvest that money at high rates of return. So if you want more detail on why I'm buying SCHD, I really encourage you to watch our next video, but I also want you to remember that it is not me sitting there saying that SCHD and dividend stocks are the way to go. I'm still being consistent. If you told me to put 100% of my net worth into SCHD at this point in my life with all my businesses going, I'd say that's not even worth it. But there's a time and place for some investments, and you might find some value in that. Thank you for your time.